What's up, everyone? Today, we're going to talk about whether it's too late to start investing in real estate and what you can do to mitigate risks. Many new investors have told me that they've been thinking about investing in real estate for a while now, but they think it might be too late for them to get started because of the market cycle, and they are worried about the risks. So is it too late to start investing in real estate? To answer this question, I want to share with you my own experience. As you probably already know, I've been flipping houses for almost 4 years now, and back in 2016, that was when the first time I started thinking about getting into house flipping. At that time, the market had come out of the 2008 Great Recession and has been recovering and growing really rapidly. In the Bay Area, where I live and invest, the market was surging like crazy. To give you an example, some homes in San Francisco were seeing a price increase by as much as 80% compared to when the prices were at the rock bottom back in 2011 or 2012. So at the time, I was thinking, home prices have gone up by so much and we were so late in the market cycle, and it's probably too risky for me to start in house flipping. So I started educating myself by listening to podcasts, reading books, and going to real estate meetings, but I just sat on the sidelines without getting in the game. So a whole year went by and we were in early 2017 and the market had no signs of slowing down. Many people were thinking that the market could go into a correction or even a crash any day. But I was getting anxious and I wanted to overcome analysis paralysis, so I decided to just jump in. I'm so glad I did it when I did it, and I was able to complete 2 flips that first year while working a full-time job. Looking back, if I didn't get started back then, I would still probably be stuck in analysis paralysis because we're only getting later and later into the market cycle. My only regret is I didn't start investing sooner, because the sooner I started, the sooner I would be able to start learning the rope and gaining experience. So moral of the story, there's no good or bad time to start investing in real estate. And in my opinion, real estate is one of the best ways to accumulating wealth and achieving financial freedom. And the best time to start is now. If you are looking for a good time to invest in real estate, that means you are looking to time the market. But there's no actual way for you to be able to time the market. Because when the market is going up, you are thinking, oh, the prices are going up too quickly and the market is expanding too fast, and you are worried about it coming down soon. On the other hand, when the market is going downhill, you are thinking, oh, the market may go down even further, and that's not a good time to start investing either. Now that I'm a full-time house flipper and a real estate professional, I never try to time the market, because you never know what's going to happen with the market, and you can never predict what's the best time to sell a home or to start investing in real estate. Since we already addressed the question that it's never too late to start investing in real estate, and the best time to start investing is right now, the rest of this video, I'm going to give you a few tips to tell you how you can mitigate risks in whatever market cycle you are in and to best protect your investments. Before we start with the tips, smash the like button below and subscribe to the channel so you can see more videos like this. Tip number 1, long-term investment is always safer. If you're just starting out in real estate, you probably want to start from long-term investments versus short-term holds. In this video, I talked about why real estate is a lot safer than many other forms of investments like the stock market or Bitcoin. Even though real estate is a safer investment in general, the market still goes up and down, sometimes as a temporary price adjustment, sometimes as a bigger market shift. If you are making a short-term play and you happen to purchase a property at a higher point of the market, and when you decide to sell after a few months or even a couple of years and the market is at a lower point, then you could be at a loss. But in the long run, real estate supply is limited. We only have so much land, especially in population centers where there are desirable jobs and appealing climate. And the demand is always growing as the population grows. So the limited supply and the growing demand determines that real estate prices will keep going up. To give you an example, in this chart, you can see that Bay Area home prices have tripled in the last 20 years. So if you are starting out in real estate investing and you want to make a safer bet, you probably want to go with a long-term play. So you can purchase a home or a rental property with holding onto it for 10 years or longer in mind. Because economic cycles are usually 7 to 10 years long, when you hold on to a property for 10 years or longer, you are riding out the economic cycles. In order to make long-term investments in real estate, you want to have a strong cash reserve. So even if you lose your job or your tenant temporarily, you can still afford to pay the mortgage for at least 3 to 6 months out of the reserve. Based on historic data, when you hold on to a property for 10 years or longer, it's very unlikely for you to be underwater, and most likely you would have a good amount of equity in the home. That being said, it doesn't mean that you cannot do short-term investments with real estate like house flipping. Even though we're very late in the economic cycle, I'm still very active in the house flipping business and I make very good profits. I believe as long as you know what you're doing, house flipping is not that risky and you can make good profits and be successful in any market. But for beginners, house flipping is definitely more risky than long-term holds. Tip number 2, invest in good locations. As I've mentioned in a few videos before, the golden rule of real estate is location, location, location. The location is the number one factor in determining a property's value. Properties that are in good location, close to job opportunities, transportation, and are in good school districts are always desirable. When the market is in an upward trajectory, homes in good locations are going to appreciate in value faster than other homes. Similarly, when the market is going downhill, homes in good locations are going to hold their value better than anything else. So when you are worried about the market risk, it's better to pay a premium and invest in good locations. Tip number 3, buy properties off market without paying market price. When you buy a property on the market on MLS, you are competing with all the buyers out there, and the price you pay would be the market price, which is how much the property is actually worth at the point of purchase. If you buy a home at market price, if the market goes down right after you purchase, it means you immediately lose money. If the market is very hot, like it is in the Bay Area for the most of the last few years, there's usually steep competition because there are way more buyers than there is inventory. And when the buyers keep getting outbid, they become desperate and more aggressive, and they tend to overbid, and that's how winner's curse happens. As an investor, you definitely want to avoid bidding wars. And a good way to get properties at good prices is to purchase them pre-market or off-market. There are many ways to get properties off-market. You could make a connection with the homeowner directly by cold calling or sending out mailers, or you could start by building relationships with real estate agents. As I've mentioned before, I get all of my deals from real estate agents. In the beginning, it could take a lot of work for you to build the relationship with the agents and start building your network. But after a while, your long-lasting relationship with the agents could provide you with very consistent deal flow. Tip number 4, use numbers, not emotion. You probably have heard of this saying, falling in love with your dream home. It's okay for a home buyer to fall in love with a home, but if you're serious about investing in real estate, you really need to put the emotions aside. When you base your decisions on emotions, not numbers, you are more prone to be irrational and make mistakes. If you are purchasing a rental property, the decision should mainly be based on how much cash flow the house is going to generate. And if you are purchasing a house to flip, then you should consider mainly on how much profit you are going to make. So most of the decisions should be made in front of a computer and not at the property. As a house flipper, when I get a lead on a potential project to flip, I can decide up to 80 to 90% whether I want to purchase the property just by having a property address and the purchase price. When I go out to see the property, it's mainly to see whether there are structural issues or there's anything uncommon that I couldn't foresee from the Google Street View. If you have seen some of the before and after videos on my flips, you probably know that most of the homes that I acquire are usually in very poor condition. And if I make my decisions based on emotions, then I probably wouldn't have purchased any of them. So the bottom line is, as a real estate investor, your decision should be all about the numbers. Tip number 5, be conservative with your numbers. If you are looking at a rental property, you want to be conservative with the potential rent income. If properties that are similar to the subject property are renting within a certain range, let's say $1,000 to $1,200 a month, then you probably want to take the middle point, $1,100, or even the lower end, $1,000 to calculate your cash flow. When you're conservative with your underwriting, if something happens with the rental market, for example, if the demand goes down or the supply goes up, your numbers are still going to be accurate and you would still be comfortable with your investment. If you're looking at a short-term investment, a flip, then you want to use the most recent comparable sales when you try to estimate the after repair value. When I look at comparable sales, I usually try to find the ones that are within the last 3 months. If you really can't find comparable sales that are within the last 3 months, then you can go back a little further, but you want to understand how the market has been trending and you want to make adjustments on the sale prices. And you want to make adjustments on the sale prices that are further out. When the market is changing very rapidly, you may even want to look at pending sales. Those are the properties that are under contract for sale, but they haven't closed, so the purchase prices are not public information, so you would have to contact the listing agent in order to find out the contract price. If you're planning a remodel on a rental property or a flip, you want to over budget for the remodel cost. Because there are almost always unexpected costs and you want to be covered when it happens. I recommend to have at least 10% of the total renovation budget as a buffer. Tip number 6, avoid uncommonness. When the property you are looking to buy has uncommon features, like on a busy street, has a flat roof or no garage, then you want to be extra careful. These uncommon features can be undesirable to your potential tenants or potential buyers. So you may want to either reconsider, or if you do want to make the purchase, you want to make sure that you are purchasing these type of properties at a deep discount. Tip number 7, have multiple exit strategies. If you are buying a rental property, you want to think about, if you can't get enough cash flow by doing a long-term rental, would you be able to furnish the place and rent it out on Airbnb and get more rent that way? Or you can also think about whether you can add an ADU, accessory dwelling unit, which is a second house on the same property, which can help you generate more rent income. And if you are doing a flip, you want to think about, if you can't sell the house at the desired sale price after a remodel, would you be able to convert it into a rental property and still cash flow? Or instead of doing a full-on remodel, would you be able to do a simple cosmetic flip by painting the kitchen cabinets, painting the interior and exterior of the house, and still sell the house quickly with a profit? Having these multiple exit strategies in your back pocket can give you options if your original plan doesn't work out. Tip number 8, start small. If you are starting out in real estate investing, whether you are buying a rental property or a flip, try to purchase a home at a lower price point, likely an entry-level home. As a rental property, these entry-level homes are most likely on the cheaper end to rent, so they are more affordable to a bigger pool of potential tenants. A bigger potential pool of tenants means stronger demand. If the economy declines, many renters may lose their jobs and they may choose to downgrade their rental homes, so you will still see a stronger demand for an entry-level home compared to a higher-end home. If you are buying a flip, an entry-level home usually has a bigger potential buyer pool and a stronger demand because more buyers are qualified to purchase them, and these homes are usually easier to resell. If you have questions regarding mitigating risks in real estate investing, drop a comment below. If you enjoyed this episode, smash the like button below and don't forget to subscribe to the channel. Thank you so much for watching. See you next time.